Welcome to Money Matters with financial advisor Russ Story of Story Wealth Management Group. With over 20 years of advising clients, Russ has some ideas to share with you based on biblical principles, financial strategies from a Christian perspective. It all starts now. Here's your host, Russ Story.
Hello, everybody. This is Russ Story with Money Matters. We're hope you're having a great day today. Hope everybody's had a good week. Hope you're looking forward to a fun weekend full of fun, family, friends, all that good stuff, you know. And just one thing about it, it takes money sometimes to have fun. We're going to talk about all kind of stuff today. We're going to talk about interest rates and bonds. We're going to talk about stocks. We're going to talk about a hedge portfolio. We're going to talk about the financial industry's big lie. So life insurance. We're going to talk about all kind of stuff. So, you know, I hope you'll hang in here with us today, fasten your seatbelt, and we'll probably have more fun than a financial show is supposed to have. That's sort of my objective. So, If you hear anything today that you think might could help you, I'd appreciate a call or an email. You can always find us at www.storywealth.com. You can email me at rstory@storywealth.com. You can give us a call at 877-240-9787. 877-240-9787. I've been doing this for about 25 years, and I've picked up a thing or two over the years. I had somebody ask me the other day, "Hey, Russ, where do you get all that material, man? All the stuff you talk about on the radio show. How in the world is it?" And I'm like, man, I could talk for hours. Okay, now, thankfully, and I know you're happy that I won't, but I certainly could. But most of the stuff that I talk about, I glean and share with you some things that I run up on day in, day out. I am a professional financial advisor practitioner. One of the things that I do, I'm involved every day meeting with clients and trying to help them to solve tough financial problems. And, you know, after years and years, you tend to see a few things, and you know there's some patterns here and some things that maybe folks need to address, and hopefully it'll help you by me sharing these things with you for you, your financial future, and the future of your family. So that's sort of what we're all about. So anyway, we're going to talk about a few things today. We're going to talk about interest rates and bonds. Now, I've talked about that a good bit. You know, case study, we're going to cover Tom and Jerry on a case study. They, in fact, this is a real situation that I ran up on this last week. And, of course, Tom and Jerry are not their actual names, but I do want to share with you some of the things and some strategies and things that we talked about in their situation. Are you playing offense or defense when it comes to your finances, your situation, your business situation? Are you playing offense or defense? There's a time to play offense. There's a time to be aggressive. And there's a time to be defensive. And we're going to talk a little bit about that. The big lie, number 4. We're going to talk about what I call the investment industry's big lie. And we're going to cover that. I'll share with you what I believe that is. It's actually average annualized rate of return. Average annualized rate of return. I believe that from a comparative mathematical standpoint, that is worthless information most of the time. Now, you know, you go down and talk to your financial advisor, and he's spitting out, well, this investment had a 6.5% average annualized rate of return, and this one had a 6.6% average annualized rate of return. Of course, you'll pick the 6.6% average annualized rate of return, and it absolutely means nothing. And I'm going to share that with you. We're going to talk about that a little bit. And then I may talk about an example of a hedge portfolio if I have time. And I know, you know, here you go. I don't have enough material, right? I got more than enough. But anyway, so let's dig right in here. First of all, I want to talk about bonds. Now, one of the things I talked about on an earlier show was the reality that typically bonds don't react well from a valuation standpoint in a rising interest rate environment. So if interest rates are going up, then you have to be careful with your bond portfolio typically, and you just got to be careful because long-term bonds, especially, the longer term a bond is, the more susceptible to valuation fluctuation or devaluation in a rising interest rate environment. So you say, okay, Russ, that sounds like a bunch of gobbledygook. Well, just here's the thing. What I'm saying is true from a standpoint of valuation and the statement values. But at the end of the day, a bond kind of works like this. If you buy a bond, say you pay, $10,000 for that bond, and a bond matures in 5 years, then in 5 years, it pays interest every 6 months. Boom, boom, boom. You're getting that interest check. Boom, boom. And then in 5 years, it matures for guess what? $10,000. So you didn't lose any money there, did you? Nope. You made money, didn't you? Yep. You got interest, didn't you? Yep. So it all kind of worked out. But if you have a longer term bond and you have that bond and 5 years after you buy it, interest rates have gone up a lot, then your statement value does go down. Now, that bond one day will either be called or it'll mature, and you're going to get the interest. So you say, oh man, I've lost money. Well, you hadn't sold it. I mean, it's not really a big deal if it's the proper, if it's a proper investment tool for the problem we're trying to solve. Bonds typically pay income. Okay. So, but there's really several different bonds, and what we try to do is diversify for our clients, and we don't want to put all our eggs in one basket. So even when it comes to bonds, we look and we try to make sure that our clients are at least exposed to the different types of bonds. There's government bonds. Those are U.S. government-backed bonds that we can buy and we hold and we draw the interest, and they're very safe. And there's also established foreign country bonds. That's the second class of bonds that we try to make sure that our clients are exposed to. Now, historically, the established country bonds, the German, Japanese, the high-quality foreign government type or corporate bonds, do pretty well in a rising interest rate environment. And there's some reasons for that. One is the issue of, currency fluctuations and currency variances, and then, and this kind of thing. So also high yield bonds, high yield corporate bonds. Back in the days of the old Michael Milken bonds, they used to call them junk bonds. You don't hear them referred to junk bonds much anymore, but typically when the economy is expanding and interest rates are going up, then, and hopefully those two things are happening at the same time, high yield bonds do pretty well in a rising interest rate environment. Last but not least, what we call floating rate bonds, okay? Floating rate bonds are tied to something like the Fed funds rate or the LIBOR or something like that, and those interest rates will rise as interest rates rise. So those work out pretty good, and it just depends on what's available and kind of what's going on. So, right now I want to stop and mention, I just talked about these 4 different types of bonds, and do all my clients have these 4 types of bonds? No. I didn't mention municipal bonds. I'm talking about, particularly in this case, for retirement plans or IRA money. But we would also want to add some municipal bonds in there as well. Depending on a person's tax situation, we would weight much heavier, or maybe we would tote a little less load of municipal bonds depending on the situation. So anyway, just to give you an idea, I talk about, and I'm always looking for bond alternatives, because we need income. Most of my clients, we need yield, while these values may go up and down a little bit. And that's really the key. I'm always looking for bond alternatives, and we've got an awful lot of really, really good ones. And by the way, I don't know of anybody else these things are offered by, especially in this neck of the woods. So one of the things we pride ourselves in doing are some private offerings and some alternative investments that we think are very special. Anyway, I want to stop right now and mention, go to our website when you get a minute. I'd encourage you to fill out one of the contact pieces. It'll take you but a second. And go in there, and we want to make sure that when we have a seminar in your neck of the woods, then what we'll do is we'll invite you to that seminar. We want you to come in, and we'll talk about several things. We'll talk about taxes and inflation and bear markets and how to protect yourself in a bear market. And we'll go over a lot of good stuff. Those are what I call the big 3 that I know that when you get 50, 55 years old, you best be taking a look at those issues and trying to plan ahead to protect against all those 3. at this time, I want to go into my case study. I thought, you may find this interesting. I don't talk a lot about life insurance, but I'm going to talk a little bit about it today. Again, before I get into that, if you think coming to one of our seminars is a good idea, I promise you, we won't squeeze your arm. We won't twist it. We won't do anything except maybe put a cup of coffee or a glass of tea in your hand. And hopefully, regardless of whether or not you want to pursue more information after that, then that'd be great. However, I promise you, we'll part as friends. So anyway, go to the website, www.storywealth.com, and go in there and put your name and where you live and even your phone number, and we'll be sure and just let you know and invite you to come to one of our workshops and seminars when it happens. Anyway, we're going to take a break right now. We are going to hear from our sponsors, and we'll be right back in just a minute.
You're listening to Money Matters with financial advisor Russ Story of Story Wealth Management Group, where their purpose is to help guide clients in making the right decisions for their financial future. Russ Story began investing in the stock market through a class in high school over 30 years ago. He spent several years in Atlanta as a vice president with Buckhead Financial Corporation, and now he operates the Story Wealth Management Group based out of Douglas, Georgia. He has lectured at the University of Georgia on issues of retirement planning and financial issues, and taught investment classes at South Georgia State College. His titles and designations include financial advisor, registered financial consultant, and investment advisor representative. For more information, remember this website, storywealth.com. That's storywealth.com. And now for part 2 of Money Matters, here's your host, Russ Story.
All right, this is Russ Story back with you. Money Matters. I'm your host, Tom and Jerry. Now, it's not the real name, but let's just say Tom and Jerry came to see me. That's a couple, and Tom and Jerry were talking, and we've done some financial planning already, and we put some things into place. And one of the things we planned for was when they pass away. Now, they're just retiring, and they're relatively young, but they sort of wanted to earmark about $250,000 per child. They have 2 daughters, and they wanted to leave. They said, well, look, we want to spend what we got here, but we would like to leave the girls about $250,000 each. And that's good. That's okay. So now, and they came in the other day, and we had a review, and we were talking about different things. And Jerry says, Russ, we were thinking, we're taking out this amount of money and X amount of money out of our investment portfolio, and you've set that up, and you're sending us that check every month. And one of the things we were thinking about, what if because we want to leave, the $250,000 for each girl. What if we bought a life insurance policy to do that? That way, maybe we could spend more of that money. Spend down more of the money so that we could, just have a little more spending money, a little more income. I said, well, clients come up with some really good ideas sometimes, and this was a good one. And I thought, well, we need to take a look at it. I said, first of all, there's some issues that we have to try and look at. First of all, we don't know when you're going to die. And, so we need to try to take a look and sort of guesstimate some things to see what, makes sense and what doesn't. And the type of insurance, he looked up a 10-year term policy, and he showed me that. And I said, well, that's not the right kind of insurance. He said, what do you mean? I said, well, the term insurance is actually, and the type of insurance is very important depending on what problem you're trying to solve. In this case, the term, the older you get, the premiums go up. So it can create sort of a bear trap, and you get to the point where you actually want to pay off and you need it, and it's so expensive that you can't afford to pay for it anymore. So you don't want to get caught in that situation at all. So we had to take a look at how much it cost, and we've done some investigation on that already. That's a good idea. And this is one of the things that we're in the process of looking at for them. It looks like there's some real advantages to it. One is the tax benefit. When the girls receive the money because it's life insurance proceeds, they won't have to pay any tax on that because they don't have an estate issue otherwise. So that's, the strategy looks like it may work out pretty well. If this is something that you think you might want to look at or consider for you and your family, then that's great. You might want to, give us a call or send us an email, and we'd be glad to talk to you a little bit and show you some numbers and figures. There's 877-240-9787 is our phone number. You can go on the website, storywealth.com, STORY wealth, WEALTH.com. And been getting an awful lot of emails, been getting phone calls from you folks out there in the radio world. So, and we appreciate that very much. If you go on the website and sign up for one of our seminars, there's a lot of things we'll talk about in the seminar and cover for you. We'll talk about the best investments to fight inflation. We'll talk about how buy and hold and sell and investment strategies that we implement. We don't think the buy and hold period is the way to go. We found that over the years, it's great. And folks say, well, eventually it'll come up. The market will come back up. Yeah, eventually we'll die too. And sometimes we don't want to have to wait till that happens. So, we find that a tactical and active approach to money management makes more sense than the buy and hold. And especially for folks who are over 55, you need to have some strategy, some discipline for protection, I believe. Also, we'll talk about the IRS. They want to take about 85%. They want to tax about 85% of your Social Security. That's a scary thought, but they do. And one of the things we share are some strategies on how to avoid and prevent having to pay those taxes on what we call the provisional income that includes your Social Security and some other things as well. One of the things we've been very successful doing is helping folks plan their Social Security income and help them to reduce taxes dramatically overall when it comes to getting their Social Security benefits. So I think that in and of itself is something you want to know about. So anyway, we're going to take a break right now. We are going to hear from our sponsors, and we'll be right back in just a minute.
You're listening to Money Matters with financial advisor Russ Story of Story Wealth Management Group. Financial security is more than just a balanced budget. It's about knowing that you're prepared to face the worst in life and that you're ready to take advantage of the best. This type of security can require a highly individualized approach to financial planning and investment management. Story Wealth Management Group is committed to providing just that, focusing on both the numbers and the people by making your unique personal aspirations a cornerstone for your tailored solutions. For more information, remember this website, storywealth.com. That's storywealth.com. Or call the office directly at 912-384-0030. That's 912-384-0030. And now for part 3 of Money Matters, here's your host, Russ Story.
All right, this is Russ Story back with you. Money Matters. I'm your host. It's good to be here today. Hope everybody's having a good day. If you're driving down the road, be careful. I'd encourage you to, I know you want to make notes. I know you want to write stuff down, but don't do it when you're driving in the car, please. Cops will get nervous about that. Speaking of nervous, the market's going up and it keeps going up and it's kind of making us nervous. And, it just seems to kind of keep rolling along. And while on the one hand, that's good, I hope you and yours are participating in that. You should be if you have a good financial advisor. That's something you've been doing for a while. But when you're 20 or 30 or 40 years old, now I'm getting into number 3 here. Are you playing offense or defense? When you're 20, 30, maybe even 40, maybe 50, you can be on the offense. You can be aggressively looking to add to your coffers. You're out here maybe taking some risk business-wise that you might not take when you're 70 or 60. Right? Because, the funny thing about it, when you get 60 years old, 70, you can't go back and undo a mistake that you made. So, to think that we can continue to do what we've done and have the same mindset when we're 20 as we have the same mindset then when we're 70 is kind of ridiculous when you think about it. But the question I've got for you, are you playing offense still? Are you trying to continue to add big money, to make big gains on your 401k, on your investment account, when you're dealing with your business, real estate dealings, whatever? When you're in retirement, you need to switch. You need to do a 180-degree turn, and now you need to go to defense. Now, that's not frankly, I don't think that's just my opinion. Frankly, it's an issue of the mathematics of investing, the mathematics of retirement. One of the things we learn, or probably you've heard of, is dollar cost averaging. Well, that's the mathematical principle that when things go up and down and you just keep adding a set amount every month or so and you're putting into your 401k, that it has a tendency to work out as long as the long-term upturn trend is up. So, but and mathematically that can help you accumulate more shares when it's down, and that way it kind of adds overall to the overall return and value of the investment after a number of years. However, that same mathematics that helps you when you're putting in to accumulate shares and more money eventually will hurt you on the backside. The reverse is true. The mathematics work both ways. The knife cuts both ways. So when it comes time, and I call it, we talk about the red zone, that 5 years before retirement and 5 years into retirement, those 10 years are incredibly important. And they can determine your quality of life financially going forward for the rest of your life. I contend it's one of the most important times. This is one of the reasons why we work hard to make sure that our clients who are in that red zone, who are getting ready to retire, who are newly in retirement, we want to make sure that we're playing good defense. So be careful. One of the problems I have with cookie cutter planning, you've got a 401k at work and you call Fidelity or some of these other guys and you call them up and say, okay, I'm getting ready to retire. And they say, okay, great. All you need to do is just deduct out of this pool of money here. We'll switch this over from a 401k to an IRA. And then as long as you take 4% or 5% a month out per year, you're going to be fine. Well, that's incredibly dangerous. And depending on when you retire, which is of no control of yours, is based on your birthday, based on when you were born. It's based on how long you've worked for the company and the provisions of the retirement plan that you have entered into working for the company. So my point is, plus, you call them and they tell you that, very dangerous. You'll be fine. But that's not necessarily true. And I think very, very dangerous. So you need to take into consideration other accounts, other income sources. You need to take into consideration what taking an income from one source or another is going to do to your Social Security benefits. And if you have no coordination, it means you really don't have a financial advisor. And I think that, buffet, hodgepodge, where, I bought this from so-and-so years ago, and I got a little of this over here. And that's a very, very dangerous and of course, unintegrated, unorganized way to do things. And at retirement, you need to get your ducks in a row. One of the things I think that I take pride in is when our clients get done dealing with us, working with us, one of the things they do, especially when they're a new client, we want to make sure they got their will in place. They got their healthcare directive done properly. They've got any power of attorneys executed the way they need them to be executed. They have any wills, trust documents. Those have been done by the attorney and executed. We want to make sure that, when they get done, they feel like they've got their ducks in a row and they can go about this, I call it the second childhood, this retirement. Without adult supervision, that they can go about the rest of their days having fun doing the things that they deserve to do and the things they want to do. So, all right, I'm switching gears on you again. I'm going to talk about the big lie. Now, in my humble opinion, this goes along with the sequence of return mathematics a bit. But it's a variant, okay? It's a little different. The average rate of return, average annualized rate of return, when you go down and you talk to your financial advisor, if what they talk about is average annualized rate of return, you need to be suspect, in my opinion, because I believe that's the investment industry's big lie. Because what you and I hear when we hear, okay, well, this investment did 2%, 6%, whatever, you and I think of it as linear, because what we've learned is that, a CD, if you hold it for 12 months, then it pays its interest, right? So, you can't do this now, but what if your CD was paying, say, 2%? That's a great rate on a CD. That's unheard of right now. Well, let's say you're getting 2%. Well, the way you and I think about rates of return is that, well, after a year, say I got 100,000 in that account. Well, at 2%, at the end of a year, I've got $102,000 in that account, right? Yeah, I mean, that's the way we look at it. So, if you've got a CD and you're getting 2%, and that thing, you're taking the interest out, well, okay, at the end of the first year, I get my $2,000. I still got my $100,000, right? Because I took the $2,000, took my interest out and spent it, and then I still got $100,000 in the next year, whatever the interest rate is. If it's 3% or 1%, I get that $1,000, but I still got $100,000. So your principle's always intact. Now, the issue is, let's take, for instance, and I think this is a great example. Let's say that we got mutual fund number 1, and this thing has an average annualized rate of return of 6%. Well, that's a pretty good rate, man. Sign me up. Okay. Well, let's take, 6%. That means I can take 6% out, right? Well, why not? You're making 6%, the man said. Well, let's say the first year it went down 30%. The second year it went down 2%. Say we had, a pullback in the market and the equity markets like we've had in the past. Well, that 100,000 now is worth, 51,000. But that's okay. We're taking 6,000 at the end of the first year, 6,000 at the end, because it'll work out, right? Yeah. Okay. So 6,000 at the end of the second year, and then we keep taking 6,000 in 10 years. Well, let's say that thing jumps up in the third year, man, it makes 10%. We're making hay now. Fourth year, 10 in the fifth, 10 in the sixth, 10 in the seventh, 10 in the eighth, 10 in the ninth, it makes 20 and it makes 30. So, man, this thing really is cooking with gas at the end there. Of course, the first year, those years at the end offset it, right? Wrong. We continue to take our 6% out. That $100,000 investment's now worth $39,000. Well, how can that be, Russ? Because if you take the negative 30 and the negative 20, add up all the 10s, add the 20 and the 30, that equals an average rate of 6%. Yeah, but what happened was you dug in deep. That 6,000 was a much larger percentage than 6% of the 70,000 when the values went down. You see, my point is, sequence of return is much more important than average annualized rate of return. I've seen investments for practical purposes that have a much higher average annualized rate of return advertised than investment B, and investment B has more money in it. Well, Russ, how can that be? Well, I just showed you. I think I just gave you an example. So anyway, be very mindful. I can do it on the other side. You say, well, Russ, you started that one at a real disadvantage. Well, how do you know you're not starting it when the market's going to go down, 20 or 30% in a year? You don't. And one thing about human beings that I've learned, we're not very good at predicting the future. I've learned that. 25 years, I can tell you that. And anybody that tells you they can predict the future, you better be very, very suspect of what they have to say. Now, I'm going to flip it around. You made 30, made 20, then you made the 10s. In the last 2 years, you lost 20 and lost 30. You'd have 105,000. You still average 6%. So that was in a very best case scenario, right? So anyway, have you taken a haircut because of this? You go in and talk to your financial advisor and he keeps telling you, oh man, this thing's done very, very well. All right, I'm going to give you one other example here. The hottest stock fund in 1999. This is a prime example of what I'm talking about. Average annualized rate of returns. Okay? Check this out. Now, this was back in the crazy days. You remember the tech bubble? You remember everybody was getting rich in the internet? Remember that? All that blew up. In 1999, the Van Wagner Fund, which bought a bunch of, internet stocks, was up 291% in 1991. If you'd invested $100,000 on 1/1/99, by the end of 99, your account value would be worth $391,000. Man, we're getting rich. But then in 2000, it lost 20, so now it's down to 309. And in 2001, well, surely it's going to come back. It just had that little burp. It had that little misstep. Well, in 2001, now it's down to 124,000. And by 2002, it lost 60%, and now your $100,000 investment is now worth $50,000. So you've gone from 100 to 391 to 309 to 124 and now to 50. Now, I don't know about your math, but I know $50,000 is about half of 100, isn't it? Problem. Now, here's what's crazy, and this is the way math will fool you. You be careful. You'll get pencil whipped now if you're not careful, okay? And these good guys, I'll tell you, a lot of guys, they mean well, and the firm that they work for has told them average annualized rate of return. They have not pointed this out. They don't know any better, okay? And I run into that all the time. But let's say that we add up our total gains. That's 291%. I'm talking about in that Van Wagner fund I've been talking about. Total losses were 140%. So that's a net gain of 150%. Well, wait a minute. Our 100,000 is now worth 50,000. How can we have a gain percentage-wise? Average annualized rate of return. Monkey math. Do you hear me? Now, you say, well, we had that for 4 years. 150% gain divided by the period of time is 37.66% positive. How many of you'd say, hey, I got an investment that made 37.66% average annualized rate of return? Man, that sounds good, doesn't it? But the real story is my 100 grand lost down to 50. You see where I'm coming from? I'm just trying to tell you and to educate you just a little bit. You got to look at total sequence of return. You can't just look at that. Now, one of the things that we all run into, and I read an article here a couple of days ago on Market Watch, and it's one of the worst articles I think I've ever read. It's not practical. It's not realistic. It's unreal. And it talked about how you do not need a financial advisor. Of course, I wouldn't like that one, right? But the reality is, here's some things that it fails to point out. We know some things, and Dalbar's done studies, BlackRock Investments, Bloomberg. There's all kind of outfits out there that have done investor return performance numbers to look at behavior and what people do actually. Because, trying to invest without a plan, a strategy, and a discipline is an emotional roller coaster. When markets are doing well, they're going up. Investors typically get excited. I just read where, there was like $80 billion going into the market in the last couple of months. Why is that? Well, the market's up. Everybody wants to jump on the bandwagon. Does it mean it's the wrong time to invest when everybody's invested? Well, it's not the best time, is it? So when markets go through correction and downtrends, folks are anxious. They are scared. They panic. Over the last 20 years, this is 96 through 15, stocks have averaged an increase per year of 8.2%. The average investor has made a little over 2. Inflation's been 2.2. The average investor has not kept pace with inflation. So now, you don't need a financial advisor. You don't need a discipline. You don't need a plan. There's a lot of things that Russ doesn't do very well. One is plumbing. I've learned the hard way. When it comes time to fix my faucet, guess what I better do? I better call some plumber because I don't know how to do it. It's not my area of expertise. The good Lord didn't call Russ to be a plumber, but perhaps he didn't call you to be your own financial advisor either. One of the things I've learned myself, before I do things, I talk to my other financial advisor brothers and friends. Because you know what I've learned? A lot of times they say a doctor that doctors himself is a fool. If I've talked about anything today and you're curious about it, I'd encourage you to talk to whoever your financial advisor may be, talk to them about it and discuss it. If they don't know what you're talking about, then you're welcome to give me a call. My phone number, 877-240-9787. Send us, keep those emails coming. It's ourstory@storywealth.com. Storywealth.com is the website. And again, I'm Russ Story. It's always good to be with you. Hope I've shared some things here today that have been eye-opening, if nothing else. I think particularly what the average investor does on his own, the sequence of return issue, it's like a maze sometimes, and it amazes me. I sit back and the mainstream media, CNBC, they talk about average annualized rate of return as comparative figures like it is what it is. And I think today I've shown something that hopefully is eye-opening. This investment industry big lie. Does that mean you shouldn't mess with it? No. I think you should go about things in a reasonable, calculated, disciplined way. I think over the years we've done an awful lot of people some awful lot of good. So again, send us an email, give us a call, 877-240-9787, storywealth.com, or send me an email, rstory@storywealth.com. I'm Russ Story, your host of Money Matters. Hope everybody has a great, safe, happy, and fun weekend. Talk to you later.
And that's another edition of Money Matters with financial advisor Russ Story of Story Wealth Management Group. Find more information on this website, storywealth.com. That's storywealth.com. Feel free to email your questions and comments to Russ at this email address, rstory@storywealth.com. The email, rstory@storywealth.com. And finally, here's the phone number to call right into the office of Story Wealth Management Group, 912-384-0030. That's 912-384-0030. Story Wealth Management Group is an independent firm with securities offered through Summit Brokerage Services Incorporated, member FINRA SIPC. Advisory services offered through Summit Financial Group Incorporated, a registered investment advisor. Investing involves risk, as you may incur a profit or a loss. Please carefully consider investment objectives, risk, charges, and expenses before investing. Past performance cannot guarantee future results. Summit Brokerage Services, LLC, and Story Wealth Management Group do not provide legal or tax advice. For services of legal or tax advice, please seek the services of a qualified professional.